Money can either be a source of stress and limitation or a tool for creating opportunities and realizing our dreams. By taking control of our finances, we gain the power to shape our future, make meaningful choices, and build a solid foundation for financial stability. I'm Giuliana Barbagelata, and in this Planning Priorities video, I'll explain 3 fundamental steps that can help you master your money. The first and most important step is to set clear financial goals. Identify your priorities by asking yourself what matters most. Is it paying off debt, buying a house, saving for retirement? Next, being as specific as possible, write goals that align with those priorities. For example, instead of writing, "I want to save money," add details like a deadline, exact amount, and purpose. In the next 4 years, I want to save $20,000 to use as a down payment on a house. Then break your goal into smaller milestones so that you can track your progress. Using the previous example of saving $20,000 in 4 years, your milestone would be to save $5,000 per year or $416 per month. While it's important to aim high, make sure your goals are attainable based on your current situation. Also realize that over time your priorities may change, which may require you to make some adjustments to your goals. Once you've identified your financial goals, you'll want to create a budget. This will help you understand where you are and where you need to improve. Start by gathering your financial information, including income, expenses, debts, and assets. Then add up all of your sources of income. Do the same thing with your expenses, making sure to include fixed expenses like housing, food, utilities, and transportation, as well as estimates for discretionary expenses like entertainment, travel, and hobbies. Then compare the totals. If you're spending more than you earn, you'll need to look at making adjustments. Look at your discretionary expenses first to identify where you can cut back. If you find extra money, pay yourself first by adding to your retirement account or emergency fund. Building up your savings using extra income can help ensure that you accomplish your long-term financial goals. As a final step, revisit your goals to see if any of them need revising based on this new information. Life is full of unexpected surprises. Having an emergency fund is essential as it can provide a safety net for unexpected expenses. Start by figuring out the target amount you want to save in your emergency fund. While a general rule of thumb is 6 months' worth of living expenses, the actual amount you save depends on your circumstances, such as job security, health, income, and debts. Then you simply need to save. I know, easier said than done, but here are some tips. Set up a separate savings account to help prevent you from spending the money on non-emergency expenses. Set up a recurring automatic transfer from your primary bank account to your emergency fund account with every paycheck. If you never see the money in your bank account, you won't miss it. Gradually increase it until you hit your target. As your income, expenses, or circumstances change, reassess your target amount as it may no longer be appropriate. Also, remember to replenish your emergency fund after using it. Remember, mastering your money is a journey that requires discipline, patience, and consistency. If you have the time and money to dedicate to this, you may not feel you need any assistance. However, for many people, especially those with substantial assets and multiple investment accounts, it may be worth getting expert help to integrate some of these elements into a holistic financial plan. If you need assistance, reach out to the experts at Henssler Financial. We're here to help. I'm Giuliana Barbagelata, an associate with Henssler Financial. Thanks for watching.